Banks don't lend out the money you deposit. They create new money every time they make a loan. Let me show you how. You walk into a bank and ask for a $100,000 mortgage. The bank approves it. You assume they're taking $100,000 from their vault or from someone else's deposits and handing it to you. They're not. What actually happens is this. The bank opens a spreadsheet and types $100,000 into your account. That's it. The money didn't exist a second ago, now it does. This isn't fraud, it's how the system works. Banks are allowed to create money because of something called fractional reserve banking. Here's the mechanic. For every dollar the bank holds in reserve, it can lend out roughly $10, sometimes more. So if the bank has $10,000 in actual reserves, it can create $100,000 in loans. The loan becomes a deposit in someone else's account. That deposit counts as new money in the economy. You spend the mortgage on a house. The seller deposits that money in their bank. Their bank now has a new deposit, which means they can create even more loans. The original $10,000 in reserves just became $100,000, which becomes $1 million, which keeps multiplying. This is called the money multiplier, and it's why the money supply is so much larger than the physical cash that exists. Here's the tension. This system only works if people believe the money is real, and most of the time they do. You swipe your card, the payment clears, everyone trusts the number on the screen. But that trust is conditional. If everyone tries to withdraw their deposits at once, the bank doesn't have the cash. It only has a fraction of it. That's what a bank run is, and when a bank run happens, the illusion breaks. The money was never fully there. It was a ledger entry, backed by confidence. The question you should be asking isn't whether the system is stable, it's what happens when the next shock hits and people stop believing the numbers.